All right, let's jump straight into it. Welcome to today's Explainer, where we're going full professional equity analyst to conduct a rigorous, no stone unturned financial teardown of Valaris. They trade under the ticker symbol VAL. Our one and only goal today? Calculating its true intrinsic value using cold, hard data. If you love cutting through the market noise and getting right into the raw numbers, you are absolutely in the right place. Here's the game plan. We're going to treat the current stock price as a hypothesis. To test it, we're running it through 3 distinct valuation labs: absolute value, relative value, and asset value, before pulling it all together in a final synthesis. Let's get to work. Starting off with Section 1, the Valaris financial baseline, where we establish the hypothesis. So, as of our provided data, Valaris is sitting at a last close price of $102.23 a share. Now, the big question, is that cheap? Or is it expensive? To figure out if that's actually a fair price, we've got to look under the hood at its recent momentum to see exactly what kind of engine is driving this thing. And wow, these numbers really set the stage. Valaris has posted explosive year-to-date returns of over 102%. The trailing 12-month compound annual growth rate for earnings per share, a staggering 445%. But even more importantly for us, analysts, the free cash flow growth is over 303%. The underlying business is clearly generating an accelerating mountain of cash. Though, as analysts, we immediately recognize that triple-digit growth like this simply cannot last forever. Moving right into Section 2, Lab 1, Absolute Valuation, where we focus on projecting future cash. In this lab, we completely ignore the rest of the stock market. We're looking purely at the cash this specific business can generate. For a pro analyst, the discounted cash flow model, or DCF, is the absolute gold standard here. We take those massive free cash flows we just talked about, project them out into the future, and discount them back to what they'd be worth in today's dollars. Now, you might be wondering, hey, why not use another absolute model like the dividend discount model? Well, Valaris pays exactly 0 dividends, so the DDM is completely useless for us here. A residual income model is also pretty tricky without a firm equity charge baseline in our data. The DCF, on the other hand, works perfectly because it lets us leverage that incredible 303% free cash flow growth. But of course, we have a few missing ingredients, which brings us to a great teachable moment. Because our source documents don't give us a specific weighted average cost of capital, or WACC, we have to bridge that gap to make our DCF work. So we plug in standard, sensible default assumptions. We project those growing cash flows, apply a standard 5 to 6% market risk premium, and assume a highly conservative 2 to 3% terminal growth rate for the long haul. Then we calculate the present value. And when the source runs those massive earnings through an absolute value model, even with our conservative long-term assumptions plugged in, it spits out a frankly mind-blowing fair value price of $645.19 per share. However, we've got to put our analyst hats back on here and note that DCF models are highly sensitive. This massive intrinsic value is heavily dependent on those recent triple-digit growth rates actually continuing into our projections. All right, Section 3, Lab 2, Relative Valuation, looking at external peer multiples. Here, we pivot. We're moving from internal cash to comparing Valaris against external benchmarks to see how the broader market is pricing it. Since our provided documents lack direct, named competitors, we're going to use a standard professional technique, using Valaris' own 3-year historical averages as our peer proxy. Today, Valaris has a price-to-earnings, or PE ratio, of just 7.31, but its 3-year average PE is 1490. It's currently trading at literally half its historical norm. If it were trading at its historical average today, the implied share price would be roughly double what it is right now. Let's look at a few other relative multiples just to confirm this trend. The enterprise value to EBITDA sits at 11.80, which is comfortably below its 3-year baseline of 12.30. Price to sales is at 2.99 and price to book is at 2.23. Across the board, these multiples are incredibly modest for a company boasting triple-digit growth. So, the big takeaway from Lab 2 is this. Relatively speaking, Valaris looks incredibly cheap right now. Based purely on how the market usually values this exact company's earnings, a 50% discount suggests a very significant undervaluation. On to Section 4, Lab 3, Asset Value, where we decode the balance sheet. For our third and final experiment, we're calculating the net asset value, or NAV. This means looking strictly at the balance sheet, what the company actually owns versus what it owes. But we hit a bit of a roadblock here. We don't have a full line-by-line balance sheet in our source data to perfectly sum up the fair market values of their equipment and subtract every single individual liability. So what do we do?
Well, we put on our detective hats and solve it by making logical deductions using the ratios we do have. First up, a debt-to-equity ratio of just 0.34 is exceptionally low. They are not heavily leveraged at all. Second, both the current ratio and quick ratio sit at a very healthy 1.77, which implies incredibly strong short-term liquidity. They can easily cover their obligations.
So even without the exact to-the-penny NAV per share, we can definitively deduce that the asset base is extremely well protected. With an enterprise value to assets ratio of 1.43 and minimal debt dragging it down, Valaris boasts a highly robust and solvent foundation. Which brings us to Section 5, Final Synthesis, determining the true intrinsic value. We run the numbers through absolute, relative, and asset-based models. Now we pull it all together, and this scoreboard really tells the story. The asset-based model proves they're financially ironclad. The relative model proves they're trading at a severe discount to their own history. But what about that massive $645 absolute value? Well, as analysts, we really have to judge that as the weakest, most optimistic estimate of the bunch, since it's likely skewed by those recent explosive cash flows that'll eventually normalize. However, because of that massive discrepancy between the calculated intrinsic value and the $102 market price, our data source calculates an absolutely huge margin of safety on earnings. It sits at over 84%. Think about that. Even if our DCF projections are way too optimistic and only half right, this margin provides an incredible, undeniable cushion. So I want to leave you with this final thought today, based entirely on our rigorous modeling. When an absolute DCF valuation points to such extreme premiums, relative multiples show a 50% historic discount, and the balance sheet shows stellar ironclad solvency, does this 84% margin of safety provide the ultimate proof that Valaris is drastically undervalued at $102? It is a genuinely fascinating question, and the data certainly makes a compelling case. Thanks for joining me on this explainer, and keep crunching those numbers.